Hello everyone, welcome back. Today we are going to discuss about the new concept, the second theory of security valuation. The concept's name is the Gordon's growth model, where we are going to discuss about another method of calculating the theoretical price of the share. So this is going to be an interesting part. But before we discuss on the new concept, let me take you to the previous lecture where we learned about a theory which was Walter's model, which was based on the concept of perpetual calculation, perpetuity calculation. And this theory also, the Gordon's model that we are going to discuss, is also based on the same concept. So starting from the scratch, we want to decide whether we want to buy, sell or hold the shares. For that, we want to know whether the shares are undervalued, overvalued or correctly valued. And in order to do the valuation, we are going to compare actual market price of the share with theoretical market price. You will get the actual market price from the actual market. You can Google it, you can go to the BSC stock exchange website or any other trading platform. But the theoretical market price is calculated with the help of theories. The very first theory was Walter's model, where we learned about this formula of calculating the P0 as dividend plus return on equity divided by cost of equity in bracket earning per share minus dividend divided by cost of equity. If you remember the numerator, it is entirely the earning per share, dividend and retained earnings. Retained earnings also have been improved so that we can include the extra return earned by the company, the more return earned by the company than the shareholders. Now we are going to discuss about the Gordon's model. And this is also based on the same concept of perpetuity value is equal to annual cash flow divided by rate of interest. So, taking the base of Walter's model, Walter said that the price of the share depends on the earnings of the share. So we used to capitalize means divided by cost of equity. So we used to capitalize the earnings in order to arrive at the theoretical price of the share. But Gordon is of a different view. Gordon says that after investment into an equity share, investor only receives dividend and not the earning. Investor do not receive or never receive the retained earning part, assuming that the company is going to operate infinitely. It is not going into bankruptcy, it is not going into liquidation or anything which will shut down the company. So assuming a normal scenario and company will run for n number of years, the only thing that the investor will receive every year from the company is dividend. So if we want to calculate the return on the investment of the share, then dividend is the only return that he is getting every year after investing this much of the amount. Then why to consider the entire earning? Why to consider the entire earning in order to calculate the price? Just consider the dividend. So in this case, market price according to the Gordon is nothing but dividend divided by cost of equity. No retained earnings in the numerator. You just remove this much of the part. No retained earnings, no extra effect, nothing. So if you update that Walter's formula, you will arrive at the Gordon's model. It is all, we can say that everything is based on the assumptions. Gordon says that Market price is dependent on the dividend received by the investors. Walter says that it depends on the dividend plus retained earnings as well. So both has a different view. Now we are going to have this view, like more practical view, that what ultimately investor is receiving is the dividend. So the cash in hand matters more than the book value. So dividend divided by cost of equity. But the perpetuity concept remains same. It says that if you want to calculate the market price today, you need a cash flow of tomorrow. So make sure that the dividend that you use in the numerator is always D1. So let me take the example. If you want to calculate the market price at time 0 and the current dividend or the last year dividend or the past dividend or dividend just paid, there are multiple names to it which we are going to discuss or experience in the coming questions. It is said that the current dividend which was declared by the company is rupees, let's say, 2. So this is not important for you. This is not the figure that you need for calculation of the market price. What you exactly need is D1. Now this may happen that the company may say that there is no growth or no change in the dividend from 0th year to 1st year. At that time D1 will also become 2 and that 2 will be kept here if there is no change in the dividend. But if there is a change in the dividend, we need to change that amount. So if there is a growth in the dividend, let's just assume that the similar situation is there and this much is the situation given in the question and the growth rate is 10%. So D1 will be 2 in bracket 1.1 means additional 10%. Right, sir. So at that time the formula will become MP0 is equal to, have a look, D1 divided by cost of equity, and D1 is calculated as D0 in bracket 1 plus growth. But one more thing you need to understand, that dividing by cost of equity means calculating the present value of all the future dividend. So if we consider cost of equity as 15%, then imagine or understand what is happening. Every year you are discounting 2 rupees by 15%. So you are taking 15% a step back every year. And on the same year you are growing dividend of rupees 2 by 10%. So you are taking it 10% ahead, bringing it 15% back. Or we can say you are going 10% or 10 steps ahead, getting back 15 steps, going back 15 steps, 10 steps ahead, then going back 15 steps, again 10 steps, then going back 15 steps. So practically what is happening is this dividend is only discounted by 5%. Growth of 10%, discounting of 15%. Growth of 10%, discounting of 15%. So if you go 10 steps ahead and first you go forward 10 steps and then you go backwards 15 steps, the net result is you are going backwards by 5 steps. Again from that point you go 10 steps ahead, then 15 steps on the reverse side back. That means again net 5 steps back. So the net discounting that is happening, see here, 10 steps ahead, 15 steps back. Then from this point 10 steps ahead, 15 steps back. So practically you are going backwards. That means discounting, yeah, right. But how much? Only 5%. Every time only 5%. That means the discounting should be only 5%. So the numerator, if we are adding the growth in the numerator, we should deduct the growth in the denominator. Okay, why we are deducting? Because cost of equity represents going backwards or discounting, and G represents going forward, means growth. Growth means going forward. cost of equity means discounting means going backward. So both are in opposite. Both are of opposite nature. That's why we are deducting. So this becomes your formula. Another thing is sometimes the situation will be like this. You want to calculate MP0 and the growth rate is given to you as 10%. Have a look. And D1 is given to you as 2.2. Now, what is the difference between this situation and this situation? In this situation, D1 is already given to you. At that time, you will assume that this growth rate is already included in 2.2. It is already included in 2.2 and you should not add it again. So, this will happen. D1 divided by cost of equity minus growth. Sir, if you are not adding growth in the numerator, then why you are deducting growth in the denominator? I did not say that. I never said that I am not adding growth in the numerator. I said that if it is already added, then you should not give it double treatment. That will be wrong, na? The growth is already there in the numerator. And the growth is added here, the growth is deducted here. If it is already given, why will I do it again now? So the same treatment. D0 in bracket 1 plus G means D1 only. So these three formulas you are going to use time to time, mostly this one and this one. Again, making sure one more thing, please note down here above question number 10. Yeah, beside question number 10. Unless specifically given or mentioned, given dividend will be assumed as D1. Unless specifically mentioned in the question that the dividend is of the past year, current year, just paid, or anything, till that time we are going to assume the given dividend as D1, means it already includes growth. Sir, why and how we are saying that? This is the general practice which has been followed in the entire syllabus. So it's my duty to make you aware about how the questions has been asked. So this is going to apply to you. Unless specifically mentioned or unless a hint is given that the given dividend is of a past year, or we can say is D0, till that time you are going to take the given dividend as D1. So we are going to use these three formulas in lots of questions, like from question number 10 to question number 37, we are going to discuss about these concepts only. Another concept is there which is called as discounted cash flows. Means, what do you mean? See, I will just explain it here. While calculating MP0, we take D1 and we assume that all these periods are perpetual. See, coming back to the basics, this formula or this formula or this formula, in all the three formulas, we are assuming that the life is perpetual. Life is perpetual, life is perpetual. Why we are assuming? Because we have derived all the three formulas from the formula of perpetuity. In this case also we did the same thing. Life was perpetual. But what if the life given in the question for a particular share is limited? Let's say, for example, you want to buy the share today and you want to know the price, theoretical price, and it has been given that the dividend will be paid for the next 3 years, and then it will be sold in the market at the third year price of, let's say, 100 rupees, and let's say the D1 is 10, D2 is 12, D3 is 15. Now tell me how you are going to calculate the market price. For that purpose, you need to understand the logic of these questions or these formulas. Whenever you write such a formula, the perpetual formula, it says that we are discounting all the future cash flows. discounting all the future dividends, discounting all the future dividends, discounting all the future dividend. It means all the future cash flows has been discounted in order to arrive at the market price. The main concept is current value is decided on the present value, on the basis of the present value of future cash flows. So after investing in a particular share, whatever I am going to receive in future, whatever I'm going to receive in future, I will just calculate the present value of that cash inflow. So let's say, for example, the present value of all the future cash flows that I'm going to receive. In this example, I will receive 10 rupees, 12 rupees, 15 rupees and 100 rupees, and after that I will sell the share. So after that I will not receive anything, only 4 cash flows that I'm receiving. So present value of, let's say for example, all these 4 cash flows at cost of equity whatever comes to 105 rupees. That means you are not receiving more than 105 rupees in terms of present value by investing in this share. If you're not receiving more, if your shares value is not more than 105 in today's term, why would you pay more than that? So automatically the cash outflow today becomes the present value of cash inflow, which is 105. You will never pay more than what you are going to receive. If I'm going to receive 105, I will never pay more than that to buy that share. So if the question comes where limited period has been given and not the perpetual, then what you have to do is, in order to calculate the market price, what you have to do is calculate the present value of future cash flows. It means that you have, if you are investing at 105 in this share and the present value of cash inflow is also 105, and let's say for example the cost of equity is 10%, it means this is your IRR. First of all, even if you don't understand IRR at this point, let it be. This means that you are earning 10% by investing in the share every year. Not more than that, not less than that. Because when you discount the future cash flows by 10%, your present value of cash inflow is equal to the present value of cash outflow. There was some concept like this in CA Intermediate Financial Management. You used to call it as IRR. IRR is where NPV is 0, and NPV is 0 when present value of cash inflow is equal to present value of cash outflow. Let it be, we are going to discuss it after 2 lectures, this one and after that also we are going to discuss these concepts, and after that means third lecture from here. First this one, second then, and the third lecture we are going to discuss about IRR. So these are few things that I have discussed with you. Okay, if we want to formulate this situation, how we can write down market price today? It's very simple, sir. D1 into present value factor at KE for first year plus D2 into present value factor at KE for second year plus D3 into present value factor at KE for third year plus MP3 into present value factor at KE for third year. Understand, the third and the fourth cash flow will have same present value factor because both are happening at the same time. D3 of 15 rupees and MP3 of 100 rupees are being happening at the third year end only. Okay, this was the fourth situation. First, where there is no growth. Second, where there is growth and D0 is given. Third, where there is growth and D1 is given. Fourth, where the time is limited. Fifth, where the time is limited but the market price at the end is not given to you. So limited, we cannot say time is limited, where the time is unlimited for a different period. So this is going to be 2-stage or multi-stage discount model. I will just tell you, multi-stage dividend discount model. So let me give you a situation. You have to buy the share today and you want to know the price, theoretical price. Question is saying that for the next 3 years, dividend will grow at 10% and D0 is given to you as, let's say, 2 rupees. Okay, just imagine the situation. But then question says that after 3 years, the growth rate will stabilize perpetually at 5%. Means the time is not limited. The growth has been divided into two different phases. For the first 3 years, it is 10%, and for rest of the years, it is 5%. So the moment from where the perpetuity starts is third year end. In this question, in this example, the perpetuity started from 0th point. In this also 0th point, in this also 0th point. Wherever the perpetuity period is starting, you have to put such formulas in order to calculate the market price. So what we are going to do here, we are going to calculate D1, D2, D3. But the fact is the time is not limited to 3 years. After that, the perpetuity is starting, and that's why we are going to calculate the market price 3 here. And MP3 will be calculated. If we are calculating the market price here with the perpetuity model, we will need the dividend of the next year. You have learned about this formula in the perpetuity. Whatever period you are calculating, the cash flow should be of the next year. So at that time, the formula will become D4. In order to calculate the market price 3, you will have to take D4 divided by cost of equity minus growth. From where you are going to calculate D4? It's very simple, sir. D3 in bracket 1 plus growth divided by cost of equity minus growth. So that's it. See, ultimately, if you will see, this situation has 4 cash flows, D1, 2, 3 and MP3. This situation also has the same cash flows, D1, 2, 3 and MP3. But time was limited here because you were given with the market price at which you will be selling the share. But here, time is unlimited and you are calculating this market price. So the conclusion is, if it is given to you, well and good. If it is not given, you do the calculation. You can calculate by putting a formula here. So ultimately, these are the 4 cash flows, present value of which will be the market price 0. And understand one thing. MP3, when you calculate MP3 at this point, it means you are discounting all the future cash flows from 4th year onwards. All the dividend has been discounted and taken into MP3. That means whenever you discount MP3 to MP0, all the future dividend has been considered. So these are the things that you will have to apply in the coming question. Even if you have understood 5% of whatever I have said, that's well and good, because rest of the 95%, or we can say we are going to practice all these things. So 5% every time will be covered in every question. So we are going to discuss about 17 to 18 questions on these models only. And the last 5-6 questions are the toughest one and only questions that you have to revise. But we are going to now start from question number 11. So it's my mistake. I had put this question number 10 at this place. I should have put this after 2-3 questions because it includes couple of concepts, and I would prefer to go with easy questions first. So we are going to start from question number 11. Whenever I think fit, I will take the question number 10 and then again I will move ahead. So question number 11 is the first question that we will start now. You can take a break if you want. I will just be back. I will just have some water, and then question number 11, we are going to start with these concepts and the formulas. I hope you have understood everything. Once I would just want you to go through these formulas and solve the question by yourself before I discuss it. Practice makes man perfect. I would want you to make mistakes and then come back and watch the lecture so that you will hold a strong grip at the end of the chapter. Bye bye. Okay, so welcome back everyone. This is Mayank and we are going to start with question number 11. One thing that I should remind before starting the question, because once I start the question and then we are going to discuss one after the other question. The thing that I want to tell you is that please make sure after discussing the concept, like we discuss the concepts and the formulas, the first thing that you should do is you should read the question and then try to solve it by yourself. Make mistakes, do the correction, make markings, everything, and then come to my discussion point, like come to the video where I am discussing the question and answer. This approach is only approach that is going to help you have a strong grip on the subject. But before you try by yourself, if you are coming directly to the video, then you are doing the most wrongful thing, or you are following totally a wrong approach. You may give any excuse to that. The very first excuse to that is I don't have that much of the time, that I will try it first. Why did I take the class then if I had to do it by myself? All and all uh, uh, worst excuses, bad excuses that you can give, but that is not going to help you at the end of the day. So you can blame me if you want, but ultimately you are responsible for your result. My approach, my guidance is restricted to this only, that I should request you to solve the question and answer before I do. So have a look. Sandy Limited has a book value per share of rupees 140. Okay, and its return on equity is 16%. See, the equity capital invested in the company is not given to you. And what is return on equity, sir? Return on equity, ROE, is nothing but return divided by equity. That is what we saw, right? So return is the profit after tax and divided by equity capital. So this is in total, but if you want to calculate the same on per share basis, then divide the profit after tax by number of share. It will give you EPS, and divide equity capital by number of share, it will give you book value per share. Book value per share, book value per share. Are you getting it? Okay, so question number 11, I will just start from here explaining the same thing. So what is return on equity, sir? Return on equity is return divided by equity capital, right? Or we can say investment, equity investment. In another sense, we call it as profit after tax for equity divided by equity capital. This is in total, but if we want to calculate the same answer on the basis of per share, then what we are going to do, we are going to divide numerator and denominator by number of share, and it will give you EPS divided by book value per share. Book value per share, right? Okay, so in the question itself, this is given to you as 17%. Am I right? Sorry, 16%. Great. And now you can see the book value per share is given to you as 140. So with the help of this, you can calculate the EPS. Am I right? That's good. Good. So you have the book value per share here. You can clearly see. Okay. And follows a policy of retaining 60% of its annual earning. So whatever they are earning, they are retaining retained earnings 60%. So if the retention is 60%, can I say that the dividend payout ratio is 40%? As learned by us in the previous question, the total earning is divided into two parts: retained earnings and the dividend payout ratio. So if retained earning is 60%, dividend payout ratio is 40%. Okay, what is the price of the share now? Means P0. If the opportunity cost of capital, what do you call cost of capital as? Cost of equity, KE, right, is 18%. Adopt a perpetual growth model to arrive at the solution, and it's very simple. Let's come down to this place. This is our perpetual growth model formula. Did we learn about this formula? Yes, sir. We learned about this formula. Market price is equal to D1 divided by cost of equity minus growth. Now, understand the fact that 22.40 is your EPS, and we already told you that DPR is 40%. So, 40% of that will give you 8.96. You will put 8.96 here. Sir, why 8.96 is taken as D1 and not D0? I already told you, unless otherwise specifically mentioned that the given dividend is of a previous year or current year or any hint is given, we are going to assume that as D1, and that's why we have taken 8.96 as D1 only. So we have the D1, we have the cost of equity. Now the question comes to the growth. So you need to understand what is the growth rate, because whatever we discussed in these five different formulas, we didn't discuss about how the growth rate is calculated. We just took the growth rate, but the question that may come to your mind is how the growth rate is calculated. So have a look on the situation now. It's very easy. Let's say you invest 100 rupees in a company. You have given 100 rupees to a company. Okay. Now that company is using 100 rupees for the entire year to do the business, and at the end of the year, let's say the company has earned around, just a second, just let me turn it in a silent mode. Okay, so you have invested 100 rupees, right? And in a year the company has earned, let's say the return on equity is 10%, which goes to 10 rupees. Am I right? So your earning per share is 10 rupees. Okay. Out of that 10 rupees, let's say dividend is distributed to the shareholder. So the dividend payout ratio is, let's say, 40%. At that time 4 rupees is given as dividend per share to the shareholder, and rest of the ratio, retention ratio or retained earnings, we can say, is 60%, which is 6 rupees. So retained earnings per share, whatever you call, that is 6 rupees per share. That's cool. Okay, now tell me one thing. The very next year what will happen? Can I say the company has 100 rupees of yours with them and 6 rupees of the extra earnings out of 10 with them, and in total they are going to carry forward 106 rupees of the capital for the second year? You tell me one thing, how much of the capital is being used by the company in the second year? 106 rupees. 100 rupees which was received in the beginning, and 6 rupees left after distributing the dividend. So 106 rupees. Okay. So next year also they are going to earn 10% on that, which will be 10 rupees 60 paisa. Am I right? 10 rupees 60 paisa. Okay, again they are going to follow the same dividend payout ratio, retention ratio, and on and on and on. Do you think there is a growth in the company? Yes, sir. There is a growth in the earnings of the company. There is a growth in the earnings of the company. How much is the growth? On the first year the earnings was 10 rupees. In the second year the earning is 10 rupees 60 paisa. So a growth to the extent of 60 paisa can be easily seen here, and that is around 6% of the total earnings. So have a look. How do we calculate growth here? Growth is the earlier EPS, the previous EPS was 10 and now it's 10.60. That means there is a growth of 60 paisa. That means the growth rate is 6%. You can just add 6% on 10 rupees and you will get a growth rate 6%. Okay, a growth rate which is 6%. Now you can clearly see that how did we calculate this? If you will understand, this plays a major role, and that extra 60 paisa comes from the retained earnings, this 6 rupees. So there are two things which are important to calculate that 60 paisa. First is the return on equity and the second is the retained earnings. So the another method to calculate the same growth rate is nothing but B into R. What is B and what is R, sir? B is the retention ratio. and R is the return on equity or return on investment. So retention ratio is 60%, am I right? Retention ratio was 60% and your return on equity was 10%, which automatically comes to 6%. Are we right? So this is how we have to calculate the growth rate. Growth rate is B into R. B is the standard term used in our syllabus for the retention ratio. So you need to always understand or remember that. So that is what is being used here. Growth is equal to B into R. 16% is the return on equity, 60% is the retention ratio, 9.6% comes to the growth rate. Now, you have the D1 8.96, cost of equity 18%, 9.6 as the growth. You can just put it here and you can calculate the market price. Nothing else to be learned here. There are two important things that you have learned here. The first thing is return on equity formula can be extended to per share basis also, which goes to EPS divided by BVPS. Then how to calculate the growth rate. You learned about this also in this question. The third thing that you are going to learn is this is theoretical market price. 106.67 is the theoretical market price and the story doesn't end here. For an investor, what he is going to do with this theoretical market price, he is going to compare this theoretical market price with the actual market price, and let's say the actual market price is 100 rupees. Now what he will do? Actual market price is less than theoretical market price according to him. He will say that the shares are available at a cheaper rate, so that's why they are undervalued. This is undervalued, na? Valuation depends on the actual market price. So 100 is less or more? Less. Under. We will call it as a cheaper rate. We can also call it as a selling it at discount. Why discount? Because according to us, it should have been sold at 106.67. But it is now available at 100. That means according to our theory, there is a discount of 6.67 rupees on this share. And that's why we will call it as selling it at discount, selling cheaper, or selling undervalued. That's why we are going to buy that share. Write down this in your compiler itself. All in all, this much of the markings should be there in your compiler so that you will build a habit of analyzing every word and extending your mind beyond the question also. So whatever we have written in the black color is not a part of the question, but we extended the answer by asking ourselves that what is the use of that theoretical market price. It's okay that the question has asked us about only calculating it, but we are not machines. We have some sense and we want to know, or we are eager to know that what is the use of that theoretical market price, and that's what is there. Ultimately, you are the investor and you want to grow your business or your wealth, and for that purpose you need to decide when to buy, when to sell. So that is the ultimate, this is the ultimate action: buy that share or sell that share, and for that purpose you are doing all this exercise. Next question please. Question number 12. Share of X Limited is expected to be sold. Underline the word expected. What do you mean by expected? Expected means it's not talking about today's value. It's not today's, it's future's value. So expected to be sold at 36 with a dividend of rupees 6 after 1 year. Just underline this, because they have said after 1 year this 6 rupees becomes D1 and this price will be of after 1 year. That means this is also market price at the end of year 1. So all in all, the story is like this. The entire question is covers only 1 year, and they are saying that the market price at which it will be sold after a year is 36 and the dividend you will receive just before selling the share is rupees 6. Now you tell me, if your required rate of return is 20%, that means you want to earn 20% from this return, what will be the share price today? So if you want to earn 20% return, how much you should be ready to pay? maximum. We can call it as how much we should be ready to pay, or we can say maximum price today that we will be paying. What you have to do in this case, see, you cannot apply this formula, because this formula is based on the concept of perpetual life. In this question, the life is not perpetual, the life is limited to 1 year. So what concept will be used here? See, if you will remember the fourth part or fifth part, whatever, the fourth part, let's say, fourth part or the fourth concept was something where we discussed about the limited life. In that part, in that exercise, we took only 3 years and we sold the share at 100 rupees after 3 years. And how did we calculate the market price today? By discounting the cash flows of future D1, 2, 3 and MP3. In this case also we are doing the same, we are going to do the same thing. We will discount these cash flows to present value and we will say that we are not earning more than that. That's why we will not pay more than that, and that's why the market price should be this much. Okay. In other way, I will write down the same is MP0 is equal to D1 into present value factor at 20% for 1 year plus MP1 into present value factor at 20% for 1 year. So it goes to 6 into 1 divided by 1.20, which is 0.833 plus 36 into 0.833, or you can do it like this, 6 plus 36 into 0.833, that goes to 35. So today the market price should be 35 and not more than that. This is the theoretical price. Okay. Is it easy? Yeah, it's very easy, sir. This is not going to come in your exam. That is just for the purpose of practice. Don't expect CA final to be so easy. Okay, question number 13 now. Have a look. The following information pertains to some Golden Limited and the profit before tax is given to you. Underline the word before. These are the minute details, but it is very important. Just after that the tax rate is given to you so that you can calculate the profit after tax. So have a look. I will just start here. PBT, sir, 75. Tax at 30% you can calculate is 22.5 and profit after tax 52.5. See, I will give you a trick to save some time. Just a second. Yeah, it is more clear now. Have a look. What did I do? First, I took 75. I hope it is very visible to you or clear to you, or else what I will do is this. Okay. So first I took 75, then I pressed multiplied by 0.30. That means I had to calculate the tax rate, and then I pressed equals to 22.5. The moment I pressed equals to, I wrote it. Give me a second, I will just connect a Bluetooth device. Okay, so it's not connecting. I will do it in the break. Let it be. Okay, so what I was saying is that the moment I pressed equals to button on the calculator, I wrote 22.5, and the next step I knew was that I had to write 75 on the calculator and then deduct 22.5 from that. So you can save time here, because you are being going through this process only. What you can do here is, after arriving at 22.5, you know that you want to deduct this figure from the previous one. I will just press two buttons. Have a look. Minus, because I want to deduct 22.5 from the previous figure which is already in the memory of the calculator, and then equal to. Otherwise, what I would have done after 22.5, 75 minus 22.5, that is what normal person will do. But this is 52.5 ultimately. So have a look. 75 into 0.30 equals to, and I want to deduct this price, that why minus, and then equals to. So this is how you can save up on your time if you want to. These are like small tricks. Okay, let's go ahead. This is profit after tax. Then equity capitalization rate, that means cost of equity. Please understand, capitalization means the cost of equity itself. So there are few names to this cost of equity. First of all, cost of equity is required return to the investor. Then it is cost of equity to the company. This is capitalization rate also, and this is discount rate also. So there are many names to these things. Please write it down here in the compiler itself. So every question will teach you something, and you should write it straight away wherever you get the space. Do not create any other book. Okay, so capitalization rate is KE, ROI 18%, retention ratio you can say 80%. With that you can calculate dividend payout ratio as 20%. Am I right? Then number of share outstanding comes to 75 lakhs, and please remember these are in crores. Okay, so I will just write down number of share in crores, which is 0.75. The base should be same. Most of the people will do it wrong. They will divide 52.5 by 75, whereas they are making the mistake. They are not realizing 52.5 is in crore, 75 is in lakhs. So divide 52.5 by 0.75, both of which are in crores. Okay, you will get the EPS here, which is 70. So once you reach at EPS, you can calculate the DPS, because dividend payout ratio is 20% of the earnings. 20% of 70 is 14 rupees. So you got the DPS. Unless otherwise mentioned, this DPS will be taken as D1. You remember that? There is no specific information that this figure of 70 or 14 pertains to the previous details, or it is current, paid, whatever the words which represents the past data. It is not there, and that's why we are going to assume it as the D1. Okay, the market price of the share of the company in the bull market. What do you mean by the bull market? Bull market means a rising market. Was somewhere around 211 2100, okay, 2100 rupees per share. Advise whether the share of Golden Limited should be purchased or not. We need to give an advice whether we should purchase this share or not. Actual market price of the share is given to you. You tell me one thing. In which situation you will purchase the share? When actual market price will be lesser than theoretical market price, you will buy the share. But when actual market price seems to be greater than theoretical market price, you will not buy the share. Instead, if you have it, you will sell it. Also suggest the form of market prevalent as per efficient market hypothesis. There are three forms of market that we discussed in the previous chapter. Weak form of market efficiency, just write it straight away here. Forget about the question. You should be able to analyze everything or remember everything that you have learned. So whatever you have learned, apply it here. Although this may not be the part of the question that write down three forms of market efficiency, but you should be able to put a habit of writing things. Weak, semi-strong, and strong. Don't you think whenever you are going to revise this question, It will help you in two ways. It will also help you to revise that particular topic from security analysis. So why are you not helping yourself? Like, there is a stack of gold placed at somewhere and you are just not making efforts to pick it up. There need to have some efforts. Now, I'm not talking about the calculation yet. I have not discussed about the calculation. I'm just going through all and all. See what I have done and what habit you should be putting in every question. They talked about capitalization rate, and immediately I wrote down all the names which we give to cost of equity. So required rate, cost of equity, capitalization rate, discount rate. Although there was no need for that much of the discussion to this. Okay. That is one habit that you need to build. Second is the form of market. They did not ask you about which form of market or write down the three forms of market. Still we wrote it. After that, they asked us whether we should buy the share or not, and we are yet to calculate the answer. And before that itself, we imagined a situation that in which situation we are going to buy the share. So I wrote down the buying share situation, but I also wrote down the other part where we will sell it. That is not a part of the question, right? They are not asking when you will be selling the share, but still I did it because that is how we should analyze and understand every question from all the other all the corners. Think out of the box. So these are out of the questions discussion. Okay. Now we are going to come down to the main question. Use Gordon's growth model. Now the Gordon's growth model is somewhat like this. So if you are not able to understand this formula, that means there is something serious which is going wrong, because you might say that you did not teach this formula to us, this formula. Okay. But ultimately I will come down to the same thing, and that will happen with you in exam also. What is E? Earning per share. What is B? Retention ratio. So if you will do the calculation, it is nothing but E in bracket 1 minus retention ratio divided by K minus BR means the growth rate. Am I right? BR means the growth rate. And 1 minus retention ratio is nothing but E into dividend payout ratio, K minus G, and E into dividend payout ratio is nothing but D1 divided by KE minus G. Sir, you taught us this formula. They are writing this formula. How we will be able to solve the question in exam? That is where you need to be what we can say, analytical. You should be able to understand the formula. It's not just about the mugging up things. What is E in bracket 1 minus B? What does it represent? First, be patient and find out what they have given. And if you have solved the question before looking at the answer, you might have started with the same formula that I taught you, and you will reach at the same answer. If the answer is same, why are you doubting this formula? In fact, this is a learning to you that there is some other way of representing the same formula. Okay, let's go. Now we are going to just put down the values. Do we have D1? Yes sir, we have the D1, which is 14 rupees. Do we have cost of equity in this question? Cost of equity in this question is 15%, right? But we are yet to calculate the growth rate, right? So growth rate formula is nothing but return on investment and retention ratio, 18% into 80%. You can just clearly see it here. Where is growth rate? Yeah, this one. So you just write down like this: 14 rupees of the dividend per share, 15% of the growth cost of equity, 14.4% growth rate. You will reach at this value. I am not in the fast track batch discussing the calculation. I assume if you are in CA final, you know how to calculate 14 divided by 0.006. So I'm not wasting time on such calculation. Now what is this? Theoretical market price. Now you decide whether your which condition is being satisfied, first one or the second one. It is the first one which is satisfied, because actual market price is 2100 and you can clearly see the actual market price is lesser than theoretical market price. You should buy the share. Although there is not much information given in the question, and the questions clearly says that it is a weak form of market efficiency because it is not discounting all information. The other information is also not given to you in the question, so I am not pretty much satisfied with the final answer of weak form of efficiency in this question, but there is nothing that we can do. This was the question asked in RTP May 2021 and you should be get going with this. According to me, there has to be more information about the efficient market, or some situation where we may or may not be following it, and then we can say that it is a weak form of market efficiency. But let it be. You just have to accept few things which may not be justified. Question number 14 is your homework. Now you know the Gordon's formula, you also know the Walters formula. You just need to put down the values and then find out the answer. So I'm just skipping this question. Let's discuss about question number 15. The first part is very easy for the 15th question. Second part is where we are going to learn new things. Have a look. Given the following information, clearly it is written that the dividend is a current dividend. Okay, so underline the word current. That means write it down, it is D0. We need to add growth in that. Discount rate, I just told you in the previous question, we call it as cost of equity. Growth rate 2%. What is the present value of the stock? When this situation is given you, it is difficult for you to understand whether the time is limited or not, whether we should use the perpetual model or not. But let me tell you one thing, unless otherwise given, it will be assumed that the life of the stock is perpetual. That means we are going to apply the Gordon's growth model here, because there is no time limit of 2 year or 3 year or 4 year given here. Okay, so we will just do it here. The answer is very simple. Market price 0 is equal to D0 in bracket 1 plus growth divided by cost of equity minus growth. D0 is 5 rupees, growth is 2%, 10% is the cost of capital, 2% is the growth rate. Easy answer, easiest answer you can say, but this is not important in this question. From the point of view of understanding, I think you can easily solve this part. The thing that we need to learn is in the second part, and there is some ambiguity in the question which I am going to explain, dictate, and you have to write it down in the question. Is the stock overvalued? Now first stop at the overvalued part and let me explain how the stock becomes overvalued. For the purpose of concluding the stock as overvalued, we need to have two things: actual market price and theoretical market price. Actual market price of 40 is given to you already, and stock will be overvalued if the actual market price is greater than theoretical market price. So we need to find out the theoretical market price now. Exactly. The next thing which is given to you is ROE 8%, earning per share 3 rupees. Show your calculation under the PE multiple approach and earnings growth model. Now the theories that they want you to use are PE multiple approach. What is PE multiple approach? It's very simple, sir. The method of PE ratio. PE ratio is market price divided by EPS. So if you transfer this EPS, you can calculate theoretical market price as PE ratio multiplied by EPS. EPS is given to you as 3 rupees. PE ratio is not given to you in the question. Now there are two things. As a last resort, I told you in the previous lecture, you can use cost of equity as 1 by PE ratio, or we can say PE ratio as 1 by cost of equity. So if you want to use this method in order to calculate the PE ratio, you need cost of equity, and the cost of equity is 10%. But what is the use of that 8%? I was also confused in the beginning. 8% is the return on equity. It is not the cost of capital. And if you will look at the answer, they have used this 8% as cost of equity. And that's where the ambiguity starts. There is a technical difference between cost of equity and ROE. We have explained it in the previous lecture at the time of Walter's model also. But it is not fair to use ROE word for the cost of equity. But looking at the answer, we can clearly see they have used KE as ROE, and that's why you have to assume it in the question. So there are two things. First of all, there should be proper explanation in the exam. Even if similar question comes in the exam, it should strike to you that we have to use 8% as the cost of equity. That's all hit and trial game that you will do in exam, and it all depends upon the situation. You cannot help it. So this is ambiguity. You can just write it down. Okay. So cost of equity will now be P ratio. P ratio will now be 1 by 8%, which comes to 12.5. So if you will do it 12.5 into 3, the market price will be 37.50, theoretical market price. At that time, what you are going to write? Sir, actual market price is 40, which is greater than theoretical market price, which is 37.5. So technically the share should be sold in the market at 37 rupees, but it is selling in the market at 40 rupees. You will easily say that it is selling at a higher price and it is overvalued, or you can call it as selling at premium also, and that's why we should not buy it. Okay, that was the question. That was the part the question was asking, that is it overvalued? Yes sir, it is overvalued. Then comes the second part, which says that earnings growth model. Now this is different from the dividend growth model, because in dividend growth model we used to grow the dividends, but what will happen in the earnings growth model? We will grow the earnings. Earnings means the EPS of rupees 3. So understand the formula. The dividend growth model was like this: D0 in bracket 1 plus growth divided by cost of equity minus growth, and earnings growth model will be E0 in bracket 1 plus growth divided by cost of equity minus growth. Sir, how come this will be the formula? It all depends upon the assumption. If you think fit, or if you think it's proper to calculate the market price on the basis of earnings, not the dividend, then the earnings growth model will be the formula. Otherwise, dividend growth model will be the formula. So the formula is like this: 3 rupees is your earning, growth rate is 2%, cost of equity 8% given to you, and then the growth rate is 2%. So it goes to 3.06 divided by 0.06, and the answer will be 51. Solving the question is very easy. Why we have used such a formula is why I am here to explain it to you. So theoretical market price is 51. Again, you are going to do the same thing. Actual market price, which is 40, which is less than theoretical market price, coming to 51. Shares are selling it at a lower price. We can say shares are selling it at a discount, and they are undervalued, not overvalued. Okay, are you good with this? So what are the two theories that you have learned in this question? First is the PE multiple approach, where you are going to calculate the market price as PE ratio into EPS. Second one is the earnings growth model, where instead of growing the dividend, you are going to grow the earnings. Coming over to the next question. Question number 16, have a look. Shares of Voyage Limited are being quoted at a price earning ratio of 8 times. So what is this 8 PE ratio? What does that mean? What if the company is earning 1 rupees? If the company is earning 1 rupees, you will have to pay 8 times of that earnings in order to buy that share. So in order to achieve an earnings of 1 rupees, you will have to pay 8 rupees. So if the company's EPS is, let's say, 10, you will have to pay 80. If the company's earnings is 20, we can say 15, you will have to pay 120 to buy that share. Company retains rupees 5 per share. So this is not the earning per share, this is retention per share, and which comes to 45% of whatever the earning per share was. So EPS multiplied by 45% comes down to 5 rupees. Am I right? This is what the sentence wants to explain, right, sir? With the help of this, you can calculate the EPS. 5 rupees divided by 45%. So EPS comes down to 11.11. EPS comes down to 11.11. Am I right? So if the 45% is the retention ratio, can I say that 55% is the dividend payout ratio? Right, sir. So 55% of this will be the dividend per share. Am I right? So retention 5 rupees, dividend 6 rupees 11 paisa, EPS is 11.11. Okay, that's good. That's good. Then again we have one more thing, which is P ratio is 8 times. We have the EPS also, we have the P ratio also. We can calculate the market price. Have a look. EPS multiplied by P ratio goes to the market price, which comes down to 88.88. Right. So we have the market price as well. Now what exactly we want to calculate in the very first part is the cost of equity if the market expects a growth rate of 15% per annum. So we are going to put down the formula here, that market price is equal to D1 divided by cost of equity minus growth. Market price we have already calculated. D1 we have calculated it. Cost of equity is the requirement and the growth rate is 16%. If you will solve 15%. So let me just correct myself. 15%. If you will solve this equation, the cost of equity will come to 21.87%. Calculation is all okay. You can do it by yourself. The doubt that may come to your mind is why growth is not added in 6.11. I told you 6.11 is not specifically given in the question. First of all, it is not mentioned specifically in the question that it is current dividend, past dividend, paid dividend, any word which represents the previous year. Nothing like this is given in the question. And I told you, unless otherwise it is specifically mentioned that the dividend is D0, we are going to assume that the given dividend is D1, and that's what we are doing it. That's why we are assuming that the growth is included in 6.11. This is the practice which was followed in the entire chapter. Second question, if we change the anticipated growth rate from 15 to 16%, what do you think the market price will be with the same cost of capital that you calculated in the first part? Now you have to calculate the market price. Take this cost of equity, change the growth rate from 15 to 16 and calculate the market price. Put down the same formula, you will get the answers. 6.11, same cost of equity, change the growth rate, you will get the market price of 104.08. Do you think I should solve this? I'm expecting you to know how to calculate. Okay. If the company's cost of capital is 20%, now we are changing the cost of equity, growth rate also, and then we have to calculate the market price. Everything is with us. See, 6.11 cost of equity, growth rate, you have the market price. This question was not at all difficult. So now I'm moving forward. Okay, I'm giving this question to you as homework. Why, I will tell you. Let me just explain few things in that, and I will also tell you what are the things to underline. A firm had been paid dividend. Underline the word paid and write it down above it as D0, because it is clearly written that it is paid last year. Underline the word last year. That means whatever is given to you as rupees 2 is D0. estimated growth rate is 5%, so 5% becomes growth rate, which we will add in rupees 2. Market price of the equity share is what we have to calculate if the growth rate of the dividend rises to 8%, falls to 3%. And the cost of equity is given to you. Everything is given to you. There are 3 different types of growth rate, 3 different market prices. That's it. Just like this. 15%, 16%, 19% growth. 15, 16, 19. In the same way, here it is 5%, 8% and 3%. Now you will solve the question. It is up to you. The question is very easy. You can see the answer. You will find it very easy. But let me tell you one more thing. The same question can be asked in a manner where in exam they will just change one word and the entire answer will be different. And I will tell you that because that is where my job is. Just circle the word to here. What they can do is they can change this word from to buy. So when you say the growth rate was 5% and it is rising by 8%, that means now we are going to add 5 plus 8 as 13. It is falling by 3%. 5 minus 3 as 2%. So instead of using 8 and 3, you will be using 13 and 2% if they change this one word. Now just imagine the same question is being asked in the exam, and by looking at the question you think that, oh, this question was there in Mayank sir's compiler. It is very easy. We have solved it multiple times and we can score entire 6 marks in this question. Let's do it. Let's grab 6 marks. You will write the answer. You will come out of the exam hall and then you will be very confident about it. At home, you will go and you will do some calculation that how many marks I will get. I will get somewhere around 70 to 80 marks. Okay. Or let's say, for example, you say that you will get 46 marks considering these 6 marks. And what will happen? You will get just 40 or below 40 or 39 or something, because all the marks will be deducted in this question because of that one silly mistake that you have done. You misinterpreted the word buy, because instead of putting 2 there, they asked you buy, rising by 8%, falling by 3%. Don't do that mistake. So be patient in exam and don't be nervous. Whenever you are nervous, you tend to forget things. Rest is up to you. So question number 18 is what? Let me just have a look. Yeah, let's take question number 18 now. See, ABC Limited just declared a dividend. Now underline the very first thing, just declared. 28 rupees per share. So this will be D0 because it is just declared. It represents the past. It represents the year for which the dividend will be paid. So it is the last year. Mr. A is planning to purchase the share of ABC Limited, anticipating the growth rate from 8% to 9%. So this 8%, underline this 8% and write down irrelevant. Because he is anticipating the growth rate will be 9%. 8% was the matter of the past and it is not relevant now, which will continue for 3 years. Now this growth rate is going to continue for 3 years. He also expects the market price to be 720 after 3 years. So what does that mean? It is the same situation as we saw in the 4th part, that there will be some kind of dividend, growing dividend for 3 years, and after that there will be some market price at which we will sell the shares. In that case, if we want to calculate the market price at 0 time, we will have to discount all the cash flows to the present value or present time. Now, what we are required to do, 1, 2 and 3. The very first thing, maximum amount Mr. A should pay for share. Underline this. And below that, write it down. Theoretical market price. What is the maximum amount that Mr. A should pay? It is the maximum that he will receive in present value terms. Cost of capital 30% requires 13%. Okay. So it's very easy. What you have to do is you have to just calculate the dividend for 3 years. 1, 2, 3. D1, 2, 3. So this is first. Second, see D1 28 rupees, you have added the growth. See, another way to calculate it is like this. First, what they did is 28 into 1.09, 28 into 1.09 to the power 2. And if you will turn the page, it will be 28 into 1.09 to the power 3. Okay, there will be some figure. So that's 36.26. Another method is to just like this, 30.52 into 1.09, then 33.27 into 1.09. So every previous figure can be multiplied only with 1.09 to arrive at the answer. Okay, let's go ahead. These are the 3 years dividend. Okay, then comes the 13% cost of capital, and this is your final formula. Just have a look on this formula. This is what we discussed while taking the concept. Present value of the first year dividend, present value of the second year dividend, present value of the third year dividend, and then present value of the market price at the end of third year at which you will be selling the share. So I think this question is very easy. We have already discussed this at the time of concept, and you will be calculating the market price, that is this. Okay. Now, second part is interesting. In the first part, it was very clear that after investing in the share, we are going to receive cash flows for 3 years, and then we will sell that share at the end of 3 years. So we knew every cash flow, and the time was limited to 3 years. Now, the maximum price Mr. A will be willing to pay for the share. That means they are asking us to calculate the same thing, but there is a difference in the situation. If he is of the opinion that the 9% growth can be maintained indefinitely, and now underline the word indefinitely. And required 13% rate of return. Now, what is the difference between the first situation and the second situation? Everything is same. 13% cost of capital was there in both the part. 9% growth rate was there in both the part. The only thing is this is perpetual life. It was limited to 3 years. This is perpetual life. And if it is perpetual, that means there is no selling price or 720 rupees. So you don't have to take 720 rupees in this situation. This is indefinitely, means we will use the perpetuity method. And it is very easy. I think easier than the first part. Simple growth model. See. D1 divided by cost of equity minus G. What was D1? D0 into 1 plus growth, which is nothing but 28 into 1.09, which is nothing but 30.52. So if you calculate, you will get the price. Easy. No need to explain the calculations. Third part. Have a look. Now, in the very first part, they asked you to calculate market price at time 0. But in the third part, they are asking you to calculate market price at time 3, not 0. The price of share at the end of 3 years, MP3. If 9% growth rate is achieved and assuming the other conditions remaining same as in 2 above. What was the condition in 2 above? That the growth rate will be maintained indefinitely and cost of equity is 13%. So, first of all, it is 9%. Second, it is indefinite period. Time is indefinite. Third, cost of equity is 13%. With these things, you have to calculate the market price at the end of third year, not zero, third year. Because if they ask you to do it at 0 point, then there is no difference in second and third part. The answer will be same. They are asking you to calculate the price at the end of third year. See. One, two, three. So here we have to calculate. Now what will happen? From this point onwards, the growth is perpetual. So in order to calculate MP3, we know that we want D4 divided by cost of equity minus growth. Now D4 is calculated as D3 in bracket 1 plus growth divided by cost of equity minus growth. Everything we have in this question. D3 has already been calculated as 36.26. See, this is D3, 36.26. So you are going to put down 36.26, 1.09, 0.13 and 0.09. You will get the answer. See. 36.26, 1.09, 13%, 9%, and your answer is here. You may ask that or you should know that MP3, while calculating MP3, we have to take the next year's dividend and only then we are going to calculate the price, theoretical price. So that theoretical price of 988 rupees, understand that theoretical price of 988 rupees stands at the third year end. So these are the three figures. You can say MP0, MP0 and MP3 market price, or P0, P0, P3. I hope this is clear to you. Question number 19 is homework to you. Easy question. You will take it. Question number 21 is also quite easy. Yeah. Question number 21 is easy. You can take it as homework. 20 and 21 both. This is based on the reverse calculation. Okay, let's do one thing. We are going to take this question. It's not going to take more time. Question number 21. Either of the two, 20 and 21 are mostly similar. So I will just take 21. Calculate the implied growth rate and return on equity. Okay, first of all, what they are asking you to calculate is this growth rate. What is the formula for growth rate? B into R, and return on equity, ROE. So first of all, let me tell you, this formula is not going to work, because in order to calculate the growth rate, you need two things: retention ratio and return on equity. And the second part itself is question that is asking us is to calculate the return on equity. So if we don't know return on equity, how we can calculate the growth? Either we will first go for calculation of the growth return on equity, and then we can calculate the growth rate, and it depends upon the data. Let's say the stock price is 65, current stock price. Next year, underline the word next year, that means this is D1. It represents futures dividend, right? Capitalization rate, we will call it as KE. Retention ratio is 50%. See, retention ratio 50%, dividend payout ratio is automatically 50%, right? So can we calculate the growth rate? Yes, sir. Growth rate can be calculated with this formula. MP0 is equal to D1 divided by cost of equity minus growth. It's very simple. Put down the prices: 65, 4, 12, growth. See, nothing else is there apart from growth, which is not known. So if you reverse the formula, it will look like this. 65 into or we can say 4 divided by 65, it will look like this: 0.12 minus growth, 4 divided by 65. So 0.12 minus 4 divided by 65 is equal to growth. growth will be 5.85%. If you go with this formula, it's very easy, right? See, I think it's easy. Then we can use the growth formula to calculate ROI. This is what the question is asking us. ROE. We know the growth, we just calculated it. We know the retention ratio is 50%. We can easily calculate the return on equity. So this question was quite easy and it was asked in the exam. I don't know which exam, but it was there. It is not written over here, but it was, I think, in May 2012 or something. Okay, good. Now the next thing to learn is in question number 22. Couple of things you are going to learn here, and that will be something the next stage of our learning. Have a look on this question. Following final information are available of XP Limited for the year 2018. Okay, some information is there. Have a look. We are going to just post-mortem, like we are going to just dig into everything and we'll see what we can where we can reach at. So the first sentence is equity share capital of rupees 10 each. What is this 10? This is face value of 200 lakhs. So can you calculate the number of shares here? 200 divided by 10, that is 20 lakhs. Okay, this is a good habit. Reserves and surplus is 600 lakhs. So if you will see, the total equity capital is 800 lakhs. Only equity capital 600 plus 200, 800 lakhs. So 10% debentures of rupees 10 each. 10% debentures of rupees 100 each, sorry. So total number of debentures will be 3.5 lakhs, am I right? 350 divided by 100, and the interest amount will be 35 lakhs. Interest on debentures, numbers will be 3.5, interest will be 35 lakhs. Okay. Then the total assets are 1200 lakhs. Okay. Asset turnover ratio is 2 times. What do you mean by asset turnover ratio? This was covered in CA Interfinancial Management. If you don't know, you should write it down here. Number of times our assets has been converted into sales. So the formula is turnover divided by assets is equal to asset turnover ratio. Don't misinterpret the formula. It is saying assets turnover ratio. So don't put assets in the numerator and then turnover in the denominator. So one more thing you should write down. I think there is some space over here. See, it should be very clear. Assets turnover ratio should look like this. Turnover divided by assets. And see the minute difference. Assets to turnover ratio will be assets divided by turnover. Write it down and you should mark this particular word. Just because I added a word to in between two words, assets and turnover, the formula has changed. In this part, it will be asset turnover, turnover divided by assets. So it is 2 times and the total assets is 1200 lakhs. So we can calculate the turnover. Can we? If we put 1200 lakhs here and 2 on that side, can I clearly say that the turnover will be 2400 lakhs? Turnover will be 2400. Good. Tax rate is 30%. Operating margin. See, operating. Underline the word operating. All operational expenses or we can say after all operational expenses, but before financial expenses. So what they want to say is this is the margin before deducting any financial expense. And what was your financial expense? Just wait for a second. Financial expense was interest. You should do the marking like this, exactly like this. So everything that we are writing wherever we are getting the space has some linking. Why we calculated interest? Because we wanted to explain that this margin is arrived, but 35 lakhs rupees is not deducted from that margin. And margin is applied on sales. Underline margin and then write down on sales. This is also called as EBIT, earning before interest and tax. Write it down. Everything that I'm writing here now, you should have that in your compiler. I have the experience of solving the entire compiler since last 3 years, 2 years, I think 2.5 years. And I know the importance of marking and writing everything here. The next time you will be revising this compiler, this question, you will immediately get an idea of what exactly is happening in that world. Okay, dividend payout ratio is 20%. First of all, dividend is applied on the profit after tax for equity. Normally the profit after tax which we arrive at, we should do one more, we should give one more treatment to that profit after tax, which is deducting the preference dividend. But there is no preference share in this question, so that's why we will forget that. Okay, so dividend payout ratio is 20%. That means retention ratio is 80%. Am I right? After that, the market price per equity share is 28. This is called as actual market price. Required return is called as cost of equity. Okay. First of all, they want us to prepare the income statement for the year 2018. Income statement starts from the figure sales. So what we are going to do, just imagine. First, deduct all the expenses from the sales which are related to the operations. You will arrive at EBIT, then deduct the financial expenses, that means interest. You will arrive at the EBT, then deduct the tax because tax rate is given. Tax rate will be applied on EBT. Then you will arrive at EAT, profit after tax. On that profit after tax, preference dividend is not there, so just forget it. You can apply dividend payout ratio to arrive at the dividend amount. Then you will be remaining with the retained earnings part. Okay, with that profit after tax divided by 800 lakh rupees of the equity and reserves and surplus, you can calculate return on equity, which you can multiply it with the retention ratio in order to calculate the sustainable growth rate. Hi, just look at this. Sustainable growth rate is B into R. Retention ratio is 80%. What is the return on equity? Return on investment. That will be nothing but profit after tax that you just calculated and equity capital, which is 800 lakhs. You will get the sustainable growth rate also. Okay. After that, determine the fair price. Underline the fair price and just mark it like this. Theoretical market price of the company share using dividend discount model. And let's just calculate it. How do you do that? It is D0 in bracket 1 plus growth divided by cost of equity minus growth. You have calculated. So we have already calculated the dividend from that point. The growth rate has been calculated in the second point. Cost of equity is already given in the question as 18%. Everything is there. If you will calculate the theoretical market price, and that will be used in the fourth part. Give your opinion on investment in the company share. At current market price, it is 28. Compare it with the theoretical price. Give your opinion. So all the four steps are linked. The second one is linked with the first, third one is linked with the second, fourth one is linked with the third. Okay, let's do it. Now, come over to this. Sales 2400 lakhs. All the working has been done here. Okay, all the working that we were doing just on the right side of the table, they have done it here. Okay, operating expenses 90%. Why 90%? Because operating income was 10%, na? So 90% is the operating expenses. Then they are deducting financial expenses. Okay, then EBT, then after tax EAT, out of that EAT you are paying the dividend. Okay, that's good. 800 lakhs rupees of the equity. Return on equity is nothing but profit after tax divided by net worth. So 17.94% is your ROE. Retention ratio is 18%. Have a look. This is sorry, this is R, this is B. You have reached that growth rate. Okay, we're going fast now because everything has been discussed. Then comes the current price. Have a look. D0 in bracket 1 plus growth divided by cost of equity minus growth. Dividend was 28.7 lakhs. We calculated the number of share for this purpose. 28.7 divided by 20. So this is your dividend. You put the D0 here, growth here, cost of equity here, growth here, you arrive at 44.93. What is the exact price? The actual market price is 28, where it should have been up to 44.93. So theoretically, price is higher and I'm getting it at a cheaper rate in the market. Whether I should buy the share or not, yes, obviously it is available at a cheaper price. Undervalued, discount. Go and buy or invest. So this was question number 22. Question number 23 is based on the same thing. Okay, so question number 23 is a homework to you, but there is one change in this question which I will explain. There is one difference in this question from question number 22 and rest of the things are same. So I will explain only that difference. The difference pertains to this particular thing. Now what is happening? Both of these are bonds. And if we calculate the interest for this, remember in the last example you calculated the interest as 10% debentures on 350 lakhs means 350 into 10%, that is 35 lakhs. Okay. But in this question if you do the same, it will look like this. 125 into 8%. That goes to 8 lakhs and 50 into 10% that goes to 5 lakhs. In this manner you will come at 125 into 8% goes to 10 lakhs. So if you go this way, you will say that the interest that should be paid is 15 lakhs on all the bonds. Okay, on all the bonds. But don't you think this 8% and 10% first of all represents coupon rate, and it is on per annum basis? Means we should be paying the interest only if we have raised the bonds on the first day of the year and we have held the bond till the entire year. For the entire year only then we are liable to pay the interest for the entire year. But in this question, either of the bond or both the bonds have not been raised on the very first day. Some or both of the bond have been raised somewhere in the middle of the year, resulting into lesser interest payment from the company. Sir, how can you say that? No date is given in the question, then how can you say that either of the two or both the bonds have been raised somewhere in the middle of the year, middle, second month, third month, 8th month, anywhere, but not at the first day of the year? Because of this particular data that is being given in the question. If both the bonds, debenture and bonds, would have been raised at one first day of the year, then 8% would have been applicable for the entire year, 10% also the interest would have been payable for the entire year. There was no need for this interest rate. Since the date of the raising bonds or debenture is not given to us, what they have done in the question is, whatever the, let's say for example, I will just tell you, this is a particular year of each quarter, let's say, okay, and 8% debenture is this, and 125 lakhs rupees has been raised, and let's say that it has been raised at the end of the first quarter. So practically speaking, company is only liable to pay 3 quarters interest payment, that goes to 6% only. If 8% is for 4 quarters, that is per annum obviously, 6% will be that there, 6% will be for 3 quarters. So 6% into 125 comes to 7.5 lakhs. Just understand this. Okay, after that 7.5, and let's say for example another, I will just match to that interest rate. So I will just revise it. 125 into 6% is 7.5. 7.5 and 5 won't be matching. So let's raise it to 7.2. Okay, let me just come down to another figure and another date. It will be some decimal or something. Let's say for example it is raised, the bond is raised somewhere here, and from this point till the end of the year the rate, effective rate, comes down to 7.2% only. But at the end of the year in the balance sheet it will still be written as 8% because coupon rate is shown there, not this rate. But effectively this rate is applicable because the bond was raised at this point. So if you calculate 125 into 7.2%, it comes down to 9 lakhs. So you will be practically speaking only paying 9 lakhs and not 10 lakhs on the debentures. And let's assume that the 10% bond has been raised at the beginning of the year. So entire 5 lakh is payable on that. So 9 plus 5 is 14 lakhs. Am I right? 9 plus 5 is 14 lakhs. Instead of 15 lakh, we are liable to pay only 14 lakhs because of the fact that either of the bond or both the bonds have been raised somewhere after the first day, resulting into lesser payment, interest payment. And if you do 14 lakhs, okay, total, if you do the total of your debentures and bond, it comes down to 175. So 14 lakhs divided by 175, I think, goes to 8%, which matches with this figure. So what they did is the total interest payment they took in the numerator, the total of the debentures and bond they took in the denominator, and then they calculated the effective interest rate which is applicable on both the bonds, 8%. And this is how they arrived at 14 lakhs. All in all, what I want to say is this information is given because of the fact that some of the bonds have been raised after the first day, and that's the reason these percentages are not directly applicable on the value of the bond. That's why that percentage will be applicable, which comes down to 14 lakhs. That's it. This is the only information which was different from question number 22. Rest everything is same in this question. So you are going to do it. Have a look. They calculated the sales, then operating expense, EBIT, then interest. Have a look. In here you should write down immediately 175 into 8%. 14 lakhs. I think they might have given here as well. So effectively 8% on the entire bonds. Rest everything is same. You can do it by yourself. So question number 23, I will just end up. Question number 24 is interesting and ambiguous because there are multiple answers possible in that question. So I'm just going to take a break and I will be back with question number 24. I think you should also take a break because this is where we will be a little frustrated, irritated, or like confused because the right answer will be something else, institute's answer will be something else, and still we will end up with a confusion. So just take a break and I will be back. Okay, so I will look on this question. Welcome back after the break. AB Industries has equity capital of 12 lakhs, total debt of 8 lakhs. You can clearly see there equity 12 lakhs, total debt 8 lakhs. So total comes to 20 lakhs of the assets. And annual sales of 30 lakhs, two mutually exclusive proposal. What do you mean by exclusive? It means that either of the two can be accepted. You do not have funds to invest in both. Both means both. Sorry, it's not boths. It's both. So proposal number 1 and proposal number 2 are the two proposals which you are considering for the next year. The details of the proposal are as under. Target assets to sales ratio. Assets to sales ratio. Understand and underline the word to. It is clear as it is written. Assets divided by sales is equal to that ratio. Okay. Target net profit margin. See, in the previous example, there was something called as operating profit margin. It means interest was not deducted from that amount. It was only operational expenses which were deducted from operating margin. But net profit margin means all expenses have been deducted, including operational and financial expenses. So this is nothing but profit after tax, or you can say profit before tax if tax rate is given. When the tax rate is not given in this question, we will assume this as profit after tax. Okay. Debt equity ratio. If you have, let's say, 2 rupees of the debt in the company, 3 rupees of the equity will be there, and exactly this ratio is matching to it. If you will write down it in a form of 8 is to 12, it is nothing but 2 is to 3. So the debt of 8 lakhs and the equity of 12 lakhs forms the ratio of 2 is to 3, which is right. Okay. Target retention ratio is 75. That means dividend payout ratio will be 25%. Am I right? Annual dividend is given in amount in proposal number 2. So whatever the profit after tax will be, out of that profit after tax, the dividend you will be distributing is 30,000 rupees. There is something called as new equity which is raised in proposal number 2. So 1 lakh rupees of the equity has been newly raised, which brings the total to 13 lakh rupees. Okay. Now you are required to calculate the sustainable growth rate for both the proposals. And the formula for growth rate is nothing but B into R. Whereas B is the retention ratio and R is the return on equity. Okay. Let's take proposal number 1. In proposal number 1, we already know the retention ratio, and the only thing that we have to calculate is the return on equity. Return on equity is nothing but profit after tax divided by equity capital. We also know the equity capital, which is 12 lakhs. The only thing which is required is profit after tax. See how we are going from last point or last step to the first step. Growth rate, B into R, then R's formula. Now we have to calculate profit after tax, which is nothing but sales into net profit margin. We have been given with the net profit margin, and the only thing required is sales, where the assets to sales ratio will be applicable. So let's just go through this way and find out the answer to this. Then I will take you to the question as well. Growth, proposal number 1. I will just go in opposite direction so that you will understand the steps. B into R. We have the B as 0.75. For R we need profit after tax divided by equity capital. Am I right? Then 0.75 into, we have the equity capital as 12 in the question directly. Profit after tax can be calculated as sales, I will just write it down here, sales into net profit margin. We also have the net profit margin, but we do not have sales figure. Net profit margin is of 4%, but we do not have sales figure. But sales figure can be calculated. See, assets to sales ratio is 0.65. So can I say sales is equal to assets divided by 0.65? Yes, sir. So 0.75 into assets divided by 0.65 into 4% divided by 12. Am I right? Good. Next step. Now we want to find out the assets. How much is the total assets of the company? Okay, sales have been given to us directly. Why we are finding out the assets then? So sorry, I will just drop this. This will be useful in the second proposal. Now we also have the sales figure, right? That is 30 lakhs. So let's just find out 0.75 into 1.2 divided by 12, that is 10%, or we can say 0.10, which goes down to 0.075, that is the growth rate is 7.5%. Am I right? The entire process, do you think anything is wrong in here? Nothing. So that the entire growth rate is 7.5%. 10% comes the return on equity. 0.75 is the retention ratio. So growth rate should be 7.5%. But there is something very serious in the answer of the institute. I am going to explain that. It was just this much if you go step by step. Now, see what they have done. Sales is 30. Okay, given. Then they calculated total assets, and total assets to sales. Total assets to sales was 0.65, and we have been given with the sales. So assets is equal to 30 into 0.65, 19.5 lakhs. So total assets were 19.5 lakhs, and the very first issue started from this point, because I will show you here. See, let's say this is the balance sheet. Okay. On this side, you have equity capital of 12, debt of 8 lakhs, which comes to 20. Let's say there are no other creditors and anything. So at least the total of the liability side comes to 20 lakhs. But total assets come to 19.5 lakhs. Total assets comes down to 19.5 lakhs, which cannot be true. Either 20 is wrong or either 19.5 is wrong. So in this manner, the question becomes wrong. So if we have to consider 19.5, the answer will change. In this answer, we considered 20 lakh as the capital, which is required. Okay. So I don't think so this has to be considered. First of all, there is no need to. 19.5. But then they considered total assets as 19.5. Okay. Even though they considered 19.5 as total assets, they calculated the net profit to 1.20 lakhs. And after that, they calculated something called as equity multiplier. There was no need to calculate this equity multiplier in this manner. They could have easily calculated it with the debt equity ratio. Debt equity ratio was 2:3. That means 3 by 5. 3 by 2 plus 3 could have been done. 3 by 3 plus 2. So that also would have given 60%. Okay. Then they calculated ROE as required, and here they have gone wrong, I think so. They are considering 1.20 lakhs as the profit for equity and debt both, whereas net profit only means the profit for equity and not for the debt. They are taking 19.50 lakhs in the denominator. Return on equity means it's very simple. There is no need to apply brains as well here. Return on equity means equity should be in the denominator. How come 19.50 lakhs is coming in the denominator? Total assets are not something which entirely represents equity capital. It can also represents debt. So I will assume it as equity plus debt. Assuming it as equity only is not right. You can say that it is equity plus debt. So what they are doing is they have taken the profit for equity and debt, which is also wrong. 1.20 is only for equity. But still, if we assume that the profit is for equity and debt, then taking the investment also for the equity and debt in the denominator, they have arrived with this formula, this much only, as a return on entire investment. And from that entire investment, which is for equity and debt both, they have separated the equity part by multiplying it with 0.60, that is equity multiplier. No logic for that. Matlab, what I can say is the logic doesn't hold true. And then they arrived at 3.69 as the return on equity, where my answer was 10%. So this entire answer goes wrong. You can do it logically in exam. Same happens with the second proposal. Same thing. This is right that they have raised the equity from 12 to 13 lakhs, like by 1 lakh. And if equity is 13 lakhs, see, there has to be some changes in the other part as well. So they said that the debt equity ratio is 4:1. That means 4 rupees of the debt for 1 rupees of the equity. So debt is 4 times the equity. Debt is 4 times the equity, 13 into 4, so it becomes 52. Now total asset becomes 65 lakhs. In the proposal number 2, it is very clear that the total of equity and debt is being treated as total assets. Here 19.5 lakh was total assets. That means I can confirmly say that they are taking equity and debt in the denominator. So 65 lakhs becomes the total assets. Okay. In this question, in this part, target assets to sales ratio is 0.62. If you go with that assets, sales figure will be different. Now, what is happening? What is happening is, for the proposal number 2, the equity capital of 12 lakh, debt of 8 lakh, annual sales of 30 lakh is not applicable. Everything for proposal number 2 has been changed, even sales and the assets as well. By just raising equity by 1 lakh, then converting equity into debt with this ratio to 54 or 52 lakhs, the total becoming 65 lakhs, then calculating the sales with that. So everything has been calculated in the proposal number 2. You should not use these figures for proposal number 2. How can you say so? Sir, this is ambiguous, because by having a first impression on the question, it is very difficult to say that these figures will not be used. The sales of 30 lakhs will not be used in the proposal number 2. And that is what they have done. They have not used the sales figure of 30 lakhs. They have calculated it in a different manner. So if you go with the target assets to sales ratio, the sales figure will differ. According to that sales figure, the net profit margin is this much. Okay. Even though if you accept the things with at this point, till this point, after that also there are some variations in the concept. They again calculated the equity multiplier, which is 4:1. If you do 1 by 5, you will get 0.2. Okay, that's cool. But return on equity, they are considering this 5.242 as the profit for equity and debt, which is wrong. Net profit is only for equity. So conceptually, what they are doing in ROE is wrong. See, 5.242 is a profit for equity and debt. 65 lakh is the assets. Total assets means equity and debt. With the help of this much of the figure, which they say it is ROI, they are separating 20% of the ROI and calling it as ROE, which is also wrong. And this way they are just calculating retention ratio and then ultimately reaching at this point. So ultimately the answer goes to wrong, wrong and wrong. So conceptually, if you will think, there are many ambiguities in this question. My advice to you is, whenever the question comes in the exam, it was there in November 24, 8 marks, you do whatever you think fit and right according to concepts. Because next time the institute is going to ask this question, institute might have, from that point, November 20 till now, they might have received lots of queries on this question, and lots of questions have already been raised on this question. So the next time they will ask, they will surely change the answer. So my suggestion to you is, go conceptually, whatever you think fit, do it accordingly, and then leave it to the God. It means that if the question is wrong, institute will give you the marks only if you have attempted that question. if you do not attempt the question saying that the question is wrong, then you are not going to get the marks. So do it wrong, but do it. That's what I want to say. For any question, not just this, for any question, the same thing is applicable. If such a question arises in the exam or comes in the exam, and my experience from the last 10 years are like that, at least 8 marks of the question in exam from any chapter will be such like you will be scratching your head for hours and you will end up wasting time. So my suggestion is, do whatever you think fit, do it fast and then move on. Leave it to the God. You will or you may not get the marks. But you cannot help it. In exam, there is no suggestion that I can give you right now. The only thing that I can tell you is solve it to the best possible. Question number 25 is an interesting question. Have a look.